Hi, it's John Kelly. In this module, we are going to discuss the risk of material misstatement. And I've talked about this before, but I've come across a particularly good example of doing this badly. And as always, we want to be efficient and effective, follow professional standards, and document what we have done properly. Now, this is about the assessment of risk of material misstatement and following that, the related nature, timing, and extent of testing. And as I said, I see this done badly a lot. And what I see people doing is skipping any real assessment of the risk of material misstatement and going straight to specifying a detailed sampling test. Do 60 of these or 40 of those. And we need to remember that standards tell us that the nature of the test we select is more important than the extent of the test we specify. But we tend as auditors to go straight to specifying a high extent test and not thinking cleverly about the nature of a test that might be easier to do and more effective. And remember the order that standards tell us to do this in. The first thing we do is document materiality. Following that, we do risk assessment procedures, including obtaining an understanding of the client's control system and how things work, and that should help us a lot in determining whether or not a material misstatement could occur. Having done that, we assess the risk of material misstatement, and I emphasize that it's not just any risk, it's the risk of material misstatement. And then if we've carefully defined how a material misstatement could occur, it should be relatively simple to design procedures, and hopefully we'll pick something efficient and effective. Now, there are several terms we find in professional standards: high or higher risk, significant risk, and key audit matters, and these may all mean different things, so let's talk about that first. High, higher, and significant are all used interchangeably in standards. Significant risk is defined as risk requiring special attention, and I'm happy to say that high or higher or significant all could mean much the same thing. Now, to a statistician, high risk probably means that you should keep testing until you find that it's wrong. And that's not what an auditor means when they say high. They mean it could be wrong, or maybe it's not, and testing will provide the answer. A number of different ways we can use the word high, and that's why it's important that we document what we mean in the audit program or the audit plan so carefully. High could mean the number's wrong. I've looked at the draft information the client has provided during planning, and I've noticed that the mortgage is in a debit balance. That's clearly wrong, and we need to do enough work to find what the right number is. It's wrong. Could also mean you've looked at something and you're pretty sure it's wrong, so you'd like some specific testing done to make sure that it's wrong or right, but if you've done some really specific testing and it turns out that in fact the number is right, well, fine, it's right. I think what we normally mean by high risk of material misstatement is it could be wrong. I'm worried about it. But if the work we do shows that it's right, then I'm happy with that. So do more than the normal amount of work to address the problem, but if having done that we find that, oh, it's right, then we're happy with that. Moderate means in the middle. Low, I think this is the most important one. We say, well, I can't think of any reason why this number is wrong. Nothing pops out to me. I've used my professional judgment. I've done risk assessment procedures. Can't think of a reason it could be wrong. Now, that doesn't mean we can do no work. We still have to do some work. But strategically, what I would hope we can do in low risk of material misstatement is use analytical procedures, use control testing, and hopefully that's going to give us almost all of the evidence we need. We had to walk the control system through anyway to do our risk assessment procedures, so doing a little more work to elevate that to the status of control testing, maybe that's all we need to do with a few other substandard procedures. And negligible is prepaid insurance, which is $2,000, and materiality is $100,000, and it was $2,000 last year too. So we're probably going to decide that analytical procedures only will deal with that. So during planning, it's really important that the partner clarify what they mean. How much work is needed? What is the nature of the risk? How do I deal with this risk? And that can be done in the planning discussions. That could be done in the description of risk of material misstatement and the intended audit approach specified in the audit plan. It could be done in detailed audit programs prepared after the partner has thought about those things. And there are other ways that can be done too. There's no one way to do it. It's just important that we make sure that by the time we're done, we've specified what we meant by high or significant and specifically the kind of work we wanted done to respond to that. Probably also important to define what we need to be done for low, because that's where we have the opportunity to be really efficient and effective and not do too much work. The other thing new is a key audit matter, and this is kind of different and separate. It's probably something that's already properly disclosed in the financial statement. Often these are going to be matters subject to significant estimation uncertainty, but they're numbers properly disclosed in the financial statement. The estimation uncertainty is disclosed. But it was considered by the auditor to be significant to the audit. It required significant auditor judgment. It was a significant or some other kind of risk. So not necessarily high risk of material misstatement. Could be other than high risk of material misstatement, but something that the auditor thought was significant to the audit. So it's a completely separate, though possibly parallel process. And here's the problem I see in examples about risk of material misstatement. You just say there is a risk, not a material risk. You just say there is a risk. And there are hundreds or maybe thousands of a risk in an audit. And if we had to do sampling for each and every one of those, we would take a long time doing the audit. So having said that there is a risk, we then leap to do a bunch of testing. No specification of high, moderate, low, or negligible. No consideration of the nature, timing, and extent of testing. And this is guaranteed at least to be inefficient, and it could also be ineffective. So here's the example. We have a not-for-profit organization that is collecting donations by credit card. And the risk identified for completeness, and we specified an assertion, so that's good. But we say there is a risk that contributions made by credit card are not deposited to the bank. Okay, I don't quite understand that, but okay, I don't know how that could occur. But then we say on a sample basis, agree daily online summary reports to the bank statement. And I'm not entirely sure how those could not agree. I need a lot more description on exactly what's going on in the control system here to understand how those reports couldn't agree. I can imagine how a donation made to the bank didn't get on the online summary report, and of course then never made it to the bank statement. But that test wouldn't find the problem. So I need more description. The other thing I don't like about this is auditing by redoing the accounting. The client is presumably using that daily online summary report every day to record transactions and to issue tax receipts. So that's inefficient and probably ineffective and certainly boring to do, I don't know, 5 a month, 60 of these things. That'd take a long time and probably have no chance of finding the problem if there was one. So that's one of my major concerns, is the test specified might not find the problem because we haven't described it properly. So it's a badly phrased risk factor. And as I said, how could it possibly be that the reports don't agree? I've tried to imagine how that could happen, and I can't come up with a suggestion of how that might happen. Now, we're supposed to know about the controls. We're supposed to have done risk assessment procedures. And based on what I see clients of mine doing, again, I can't see that happening. If there is something and the client is not reconciling these reports to the cash received, I would say that's an internal control weakness. And if they did that last year, why didn't we report this weakness last year? So the fundamental problem is the risk factor does not describe how it could go wrong. And if you don't describe in your risk factor how it could go wrong, the staff are not going to be able to design procedures to find out whether or not it's wrong. So of course it's a risk, but is it high, moderate, or low? And the risk assessment procedure I would do, and perhaps even the audit procedure I would do, is I would ask someone not involved in the cash receipt process to say, how often do donors phone up and complain and say, hey, I made a donation and I never got a receipt? And based on the kind of controls I've seen at not-for-profit clients of mine, I would expect that they would look at you in shock and say, that never happens. That just doesn't happen. We reconcile, we compare, we test, we do all kinds of things. It never happens. So if that's the answer you get, I think you would assess the risk of material misstatement as either low or negligible. And maybe you might put that question in your audit program as well, and your risk assessment procedure, now that it covers the whole year, the inquiry, might be sufficient appropriate audit evidence to convince you that that was not a problem. But we don't know what the problem really is because it hasn't been properly described. The only thing I think we can conclude is that the testing that is specified is too much and boring and won't find the problem. So that's bad. So what we need to do is always remember professional standards. We document materiality. We do risk assessment procedures and understand the client's system of internal control, which will really help us understand where mistakes could occur. We will then assess risk of material misstatement, high, moderate, or low. And then we will design procedures to give us a high, moderate, or low level of assurance, not necessarily doing large size samples, because sometimes very simple procedures can give us a high level of assurance that the number is right. So, thanks for listening.